Investors, like Allie, typically fixate on the investment portfolio return. She might be thinking, how much did I make on the sale of that stock? What was my total return over my holding period? But you know what? That's not actually the number that she should be focusing on. Rather, the number that really matters is your after-tax return. That's the amount of money that actually goes into your pocket. That's the actual amount of money that you have to spend, to save. And here's the good news. There are actions you can proactively take to reduce your tax haircut, the reduction in return due to taxes. Hi, I'm Harry Starn, and welcome back to another Starn Standard Practical Knowledge video. In this recording, I'll share strategies to help you pay less on taxes for your investments. The content that you'll be introduced to includes harvesting tax losses, identifying the cost basis of the security that's used in the tax calculation, holding investments for long-term capital gain recognition, positioning assets in the right type of account, investing in tax-exempt securities, and minimizing portfolio turnover. Additionally, you'll learn about qualified dividends. Awareness and application of these strategies will result in less tax payments and more money for spending and savings. The Internal Revenue Service, the IRS, allows taxpayers to offset capital gains against capital losses. For example, if an investor had a $10,000 long-term capital gain and a $10,000 long-term capital loss, then there's zero gain for tax purposes. The gain and the loss cancel each other out. The same netting is applied for short-term capital gains and losses. Tax loss harvesting is the strategy of intentionally selling portfolio holdings that represent a current loss to offset securities that were already sold for a gain. This is a powerful strategy that you'll want to apply over your lifetime. Not only do you minimize the tax liability in the current period, but the strategy helps you keep that portfolio fresh. Sale proceeds from the losing security can be reinvested in another security that you believe is positioned right now for above average capital appreciation. Consider this example. The $4,250 capital gain from selling Fund D can be partially offset by selling Fund A, which has a $2,700 capital loss. The action will lower the capital gain tax liability to $1,550. A fundamental concept of U.S. tax code is that you don't pay taxes on the same dollar twice. For example, let's say you purchase an investment for $100 that you paid with out-of-pocket money. If you later sell the investment for $300, your gain is $200, not $300. That initial $100 investment, which you paid with post-tax dollars, is referred to as your basis. It's important that you keep accurate records for both your original contribution and additional dollars over time. The sum of your original and subsequent investment dollars less any decreases is referred to as your adjusted basis. Your net gain on the sale of that security equals the sale proceeds less your adjusted basis, less any transaction costs in completing the sale. When you purchase additional shares over time, but sell only a portion of your total holdings, the IRS permits you to select your cost basis for calculating the basis of the sale. 4 commonly employed methods for determining the security's cost basis are first in, first out, FIFO, last in, first out, LIFO, by specific identification or by specific lot, and the average cost. Your choice of cost basis impacts the taxes due. Consider this example. An investor purchases 100 shares of stock over 3 different dates. The share price for each of the purchases was $40, $64, and $55 respectively. What is the taxable gain if the investor sells 200 of those 300 shares? Well, the tax liability depends on the cost basis approach used for the sale. As depicted on this slide, the lowest capital gain results from selling the most recent sales first, the last in, first out approach. The combined basis is $11,900, resulting in a taxable gain of $4,100. Once you decide on the cost method for that particular investment, the IRS expects you to continue using that same methodology until all the shares are sold. Note, you could elect one cost methodology for the first investment. You could use a different cost methodology for another investment. Do you see how effective use of cost basis can impact the capital gain tax due? Securities that are held for at least 1 year and 1 day are taxed at the favorable long-term capital gain rates, while securities held for 1 year or less are taxed at short-term capital gain rates. Note that the short-term capital gain rates are effectively the same as your ordinary income tax rates. The general rule of thumb is that you never hold a security that you feel you really need to sell just to protect the long-term gain tax recognition. However, if the sale of that security is not critical today, then you can consider saving on taxes by deferring the sale until you do reach that 1 year and 1 day hurdle. I invite you to watch other Star & Standard videos explaining income tax planning, including the progressive tax rate schedule for ordinary income and the flat rate tax structure for long-term capital gains. There are 3 types of investment accounts based on taxation. Taxable accounts, like a brokerage account, tax-deferred accounts, like a traditional IRA or your traditional employer retirement plan, and tax-free accounts, Roth IRAs, Roth employer plans. Efficient tax strategy involves matching the attributes of the account to the characteristics of the security. In essence, tax-advantaged securities should be placed in taxable accounts since they are already tax advantaged, while securities that would be taxed at short-term capital gain rates or ordinary taxable gain rate, ordinary income rates are best placed in tax advantaged accounts. The content on this slide summarizes the types of securities that should be placed in taxable investment accounts and the type that, if possible, should go into tax advantage accounts. As shown, municipal bonds are tax exempt at the federal and state level, that state of issue, the home state. U.S. Treasury bonds are tax exempt at the state level, and securities held for over a year are taxed at the favorable long-term capital gain rates. Given the security characteristics, it makes sense to hold them in a taxable brokerage account. In contrast, high income producing assets like a corporate bond are taxed at the higher ordinary income tax rates. Securities held for 1 year or less are taxed at short-term capital gain rates. For zero bonds, you're taxed every year on the accrued interest, even though you don't receive that money. For TIPS, you're taxed each year on any inflation adjustment to the principal amount, even though you don't receive the cash. Given the characteristics of these securities, it makes sense to hold them in a tax-advantaged account. When you purchase a corporate bond, the dividends you receive are taxed at both the federal and the state level. You incur two sets of taxes. However, federal and state authorities respect each other when it comes to the taxation of government debt. Interest on federal debt, like a U.S. Treasury note, U.S. Treasury bill, is taxed as income at the federal level, but it's received tax-free at the state level. Interest on the state municipal bond is tax-exempt at both the federal and the home state level. A strategy that you could use to reduce taxes is to sell corporate bonds and purchase federal or state debt. While there be a tax savings, it's important to realize that the interest earned on the municipal bond is less than a corporate bond of a similar credit rating. As an investor, you need to make an apples for apples comparison by either calculating the after-tax yield of the corporate debt or the tax equivalent yield on the municipal debt. Consider this example. An investor has a choice between purchasing a 4.8% corporate bond or a 4.0% municipal bond. The investor's marginal tax rate in this scenario is 22%. Which means that for every dollar received, the investor gets to keep 78 cents. 100% minus the 22% marginal tax bracket equals 78% income retention. 4.8% times 78% equals 3.74%. In this example, the investor would be better served holding the municipal bond yielding 4.0%. Selling an investment held in a taxable account generally creates a taxable event. There are some exceptions, including the wash sales rule and like-kind exchanges that have been approved by the IRS. However, frequent portfolio trading will reduce tax efficiency. For example, the more you trade, the higher the likelihood the transaction will incur a short-term capital gain implication. In contrast, a low turnover strategy, such as buying and holding a security or purchasing a low turnover mutual fund, will often result in long-term capital gain recognition. Additionally, it helps to increase your time invested in the market. And time in the market, not timing the market, is a key principle of long-term success. There are two types of dividends, ordinary and qualified. An ordinary dividend will be taxed as ordinary income, while a qualified dividend is taxed at the lower long-term capital gain rates. For a company's dividend to be deemed qualified, the company needs to meet IRS requirements. In addition to that company-level qualification, the individual investor must meet the minimum holding period requirement. For stocks and equity mutual funds, the minimum holding period is 61 days out of a 121-day period. The window of time is shown here on this slide. In this video, you discovered strategies that will help you keep more of your investment gains. These strategies included tax loss harvesting, identifying your cost basis, holding securities for long-term gain recognition, placing securities in the right type of account, replacing taxable income with tax-exempt income, minimizing portfolio turnover, and purchasing securities that are offering qualified dividends. Every tax dollar you save as the result of your prudent planning can be reinvested for compound growth. Now, you may want to meet with a tax professional, perhaps an enrolled agent or a CPA, particularly if your tax situation is complicated. If you do, I trust that the information you learn in this video will promote a meaningful conversation. Well, thank you for watching this practical knowledge STARN standard video. I invite you to watch other videos that I've posted about investments or tax planning or even other pieces of the financial planning puzzle. If you found the content useful, then please tap the like button. Click on the bell for future notifications and subscribe to the Star Standard channel. Have a great day and hope to see you in a future video.